In forex trading, your chart is your map. It shows you where the market has been and hints at where it might go next. But just like reading a map, one wrong interpretation can take you completely off course. The truth is, most traders don't lose because of bad strategies. They lose because of charting mistakes. So let's talk about the most common ones and how to avoid them. One of the biggest mistakes is cluttering your chart with too many indicators. Many beginners think that more tools mean more accuracy, but in reality, it often creates confusion. When your chart looks like a rainbow of lines, oscillators, and signals, you stop seeing the actual price action. The chart should guide you, not overwhelm you. Remember, simplicity is power. Stick to a few indicators that complement each other and help you confirm what price is already showing. The second common mistake is ignoring higher timeframes. Traders often zoom into the 5-minute or 15-minute charts looking for quick setups and completely forget about the bigger picture. The problem is the real trend, the one that drives long-term price direction, lives on higher timeframes like the 4-hour or daily chart. Before entering any trade, always zoom out and ask, am I trading with the trend or against it? When your trade aligns with the larger structure, your probability of success increases dramatically. Another mistake is drawing inaccurate support and resistance levels. Some traders draw lines everywhere, at every small swing, and end up with a chart that looks like a spider web. Support and resistance should highlight major turning points where the market reacted strongly, not every minor fluctuation. The more clean and clear your levels are, the more meaningful they become. Then there's the issue of forcing patterns that aren't really there. Sometimes traders want to see a head and shoulders or a double top so badly that they convince themselves it exists. But markets don't always form textbook shapes. Forcing patterns creates false confidence and leads to poor entries. Always let the chart speak for itself. If a setup doesn't look clear and natural, it's probably not worth trading. Another major charting mistake is neglecting trend lines and structure breaks. Traders often draw trend lines inconsistently or forget to update them as new highs or lows form. A broken trend line can be an early warning sign of reversal, but only if it is drawn correctly. Update your lines regularly and combine them with confirmation tools like volume, candlestick patterns, or moving averages. And finally, the mistake that ties it all together: not having a charting routine. Many traders jump onto the chart, draw a few random lines, and enter a trade within minutes. Professionals do the opposite. They analyze step by step, start from the higher time frame, identify the trend, mark key zones, then drop down to lower time frames to plan precise entries. This structured approach keeps your analysis consistent and objective. Charting isn't about making your screen look impressive. It's about clarity, logic, and discipline. Every line, every zone, and every indicator should have a reason to exist. The goal isn't to predict every move. It's to build a clean, readable story that helps you make confident decisions. So before your next trade, look at your chart and ask yourself, is this helping me see clearly, or is it just noise? The answer to that question could be the difference between guessing and truly understanding the market.